Hello, this is Luke McCarty with McPherson Financial Group. Today, we're going to go over some changes we've made across most of our portfolios in October of 2021. First thing I want to show you guys still is the economic indicators. These were all green and positive at the end of September. If you had a chance to watch our Q3 video that ended in September, you can see it was kind of go, 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 right? The market had a little pullback in September. Since then, the market's been up for most of October, almost back to new all-time highs. So from the economy standpoint, things are still looking really good. We're still risk on. We are going to make a few changes to help with the volatility of our portfolios. Portfolio changes that we made in our stock models, we removed Disney and replaced it with JP Morgan. So most recently, Disney got downgraded by one of the big analysts, saying that their Disney Plus subscriptions were kind of COVID related and they're going to slow down. But thinking back to Disney for the past year, right, I've mentioned this to some clients in client meetings, is that Disney's had great quarterly, quarterly reports and quarterly guidance for the last 2 quarters, but we have not seen the stock increase. So it's been pretty flat for the year. Most recently, it's been down. The replacement with JP Morgan, right, as interest rates rise, banks and financials tend to do better. JP Morgan has a diversified revenue stream from, they have the banking side, right? They have JP Morgan Chase, right? The credit card side. Then they have their investment arm, and they have a lot of different revenue streams. So we like JP Morgan in a rising interest rate environment, but we really like JP Morgan from kind of the bigger picture, from all the ways they can earn income. One of our biggest adds for October was we added T.Rowe Price Capital Appreciation Fund across almost every model except for our enhanced dividend and our income model. We're going to go more in detail about that. And then we added JP Morgan Hedged Equity to our stock model and our max growth model. So T.Rowe Price Capital Appreciation Fund, the overview of this fund is, over the last 15 years, it delivered 98% of the S&P 500 return while taking 69% of the risk. So this is one of our plays within our portfolio to reduce your risk while keeping your returns up with the market. This fund has 3 objectives, right? Generate strong risk-adjusted returns annually, preserve shareholder capital, and generate equity-like returns with less risk than the overall market. This fund, right, PRWCX, T.Rowe Price Capital Appreciation, has been closed to new investors since June 30th of 2014. We were able to receive an exemption with T.Rowe Price to purchase across all of our models because I have personally owned this fund since May of 2014. This fund has only had 2 years of negative performance since 1987. That was in 2008 and 1990. Over the same time frame, the S&P has had negative returns in 2018, 2008, 2002, 2001, 2000, and 1990. So this is how it is able to keep up with the S&P, because it has less risk, less negative years of performance. JP Morgan Hedged Equity. A couple of videos ago and earlier in the year, we've been adding this as a bond alternative to some of our portfolios with bonds. We are now adding it to our stock model and our max growth model, because I'll show you in a couple slides later, we're kind of at the top range of the market per se, from a secular bull market perspective, where we can see a little bit of pullback that would be pretty normal, kind of, similar to September. But this is going to help reduce our volatility, but also still give us the upside performance. Real quick on this, if you look in the far top right, the average cap, right, that's quarterly. So quarterly, the cap is between 3.5%, 5.5% of what you can make per quarter. So if the S&P 500 goes straight up, right, like after COVID of March 2020, if it just goes straight back up, right, we're going to miss out on some of this. However, I don't feel the market is going to be that strong of a rally from here on out. It's going to maybe be a slower with a lot of volatility. This is going to help reduce our volatility while also giving us some upside in the market. Our market outlook, right? Since our indicators were all positive at the end of September, the stock market has rallied, right? The Dow most recently hit new all-time highs. We believe we will continue to trade in a range-bound environment where 2 standard deviations above the moving average will be overbought, and then 2 standard deviations below will be oversold. I'll show you a chart about this next. However, markets can always break the range to the upside or the downside. Our goal with reducing risk right now in the month of October is to help when the markets are close to the top of this range and help prevent the drop to the bottom of the range as we continue in the secular bull market. Here is the S&P 500 year to date. These are these bands in here. They're called Bollinger Bands. The orange line is the 20-day moving average, and the shaded area is 2 standard deviations above and below. If you go back to September, right, the beginning of September, we were at the top of the range, right? Then we fell down into the bottom, went actually a little bit below 2 standard deviations below. Typically in markets like we're in, it kind of bounces off the bottom and goes to the top and then kind of bounces off the top. So we're kind of seeing this pattern go forward. If it continues, right now is a great time to help reduce some risk. So that way when the market slows down a bit or has a little bit of a pullback, our portfolios won't experience that full pullback. But now's a great time to hedge some risk on the upside, when we're at this high of the market from the Bollinger Band perspective and using some standard deviations and some technical analysis. Thanks for watching this video. All right, contact us. Once again, I'm Luke McCarty. There's my email. There's Art's email, our office line. Call us with any questions you have. We're going to continue making changes to your portfolios and be more actively involved when it comes to this type of market that we're in. And then here is our disclosures. Thanks for joining. Call with questions and hope to see you guys all soon.